Stephen Schwartz, who's Asia economist at BBVA, joins us on the show with his perspective on the market. Stephen, it's good to have you on the show. What's your view on the Chinese PMI data and how that may impact the Asian markets?
Well, the official PMI reading that came out on Sunday was better than expected, much better, but it's heavily influenced by seasonal effects and some lingering effects from the Chinese New Year. So we are viewing that number a bit cautiously, and at the same time, the private sector PMI number, HSBC number, turned down. So it's giving us a mixed reading, which highlights again seasonal factors, and also the private sector index is more focused on smaller and export-oriented companies, which are certainly performing weaker than the larger companies that are captured in the official index. But it's a good reading overall, and it supports the case that domestic demand is being sustained even in this environment of weak external demand.
High oil prices are a huge concern for Asian economies. How are you viewing oil prices for FY13, where unresolved geopolitical tensions are still supporting oil prices?
Right. Well, we're raising our baseline outlook for oil prices by about 20% compared to what we had just a few months ago. Because of the tensions in the Middle East, we think it's largely a supply-side driven run-up in oil prices, although there might be some demand-side effects because of the higher growth outlook that's in the markets right now. But high oil prices is not good for Asia. But at this stage, when we look at the growth outlook, we think so far it's only having a modest negative effect on the growth outlook, typically 0.1 to 0.3 percentage points shaving off growth in 2012. Because as the external environment picks up, that helps to offset some of the impact. But certainly some of the economies in the region that stand to be hit harder are the large oil importers, such as Japan and India. Those two economies, we would probably tend to shave back our growth outlook a little bit more than the others because of the impact of high oil prices.
What's your view on Asian currencies in the context with India? Which currency would you prefer?
Well, the outlook for Asian currencies at this stage is heavily dependent on the outlook for global risk aversion. And under our baseline expectations of a gradually improving external environment in the U.S. and with Europe stabilizing, though not out of the woods, we would expect risk appetite among global investors to return and be sustained in the second half of the year, together with the very easy monetary conditions in the U.S., Europe, and Japan. That should set the stage for capital inflows back into the region, and that would set in train a gradual appreciation path for most Asian currencies in the second half of the year. Now, the currencies that stand to benefit the most would probably be the currencies that haven't seen significant increases in value lately. So we would put perhaps the Indian rupee and the Korean won up there as two currencies that might stand to benefit the most if there is a return on a sustained basis of capital inflows to the region.
Right. In terms of economic growth, which are the countries in Asia that would attract majority of capital flows on a fundamental basis? If at all QE3 happens, which Asian country would attract more capital flows? What is the expectation of how much of those flows will come in for countries like India?
Well, the region as a whole, I think, really stands to benefit. Asia continues to be the world's fastest growing region, and investors will certainly pick and choose among the different economies. But again, I think that the currencies that haven't seen the biggest run-up so far would stand to benefit, and to the extent that money's coming in on a short-term basis, we might see flows into the likes of Korea and India. But on a longer-term basis, Indonesia remains a favored destination among FDI inflows, and the high outlook for commodity prices given Indonesia's role as a commodity producer, and also Australia in that regard, should support sustained inflows into those economies later in the year.